Michael Saylor's bold bet on Bitcoin once seemed like a masterstroke of corporate genius. He was the first CEO to transform his company's treasury into a massive Bitcoin vault, turning what was once a sleepy software firm into the heartbeat of crypto enthusiasm on Wall Street. Investors cheered his defiance of convention, and the market rewarded him with something extraordinary, a Bitcoin premium that made his company's stock worth far more than the value of the actual Bitcoin it held. Saylor became a legend, the man who dared to stake his future on digital gold. But markets have long memories and sharp teeth. The very strategy that made him famous is now dragging him through a storm of backlash, with shares of Strategy Inc., the rebranded MicroStrategy, sliding 15% in a single month. The question no one wanted to ask before is now unavoidable. Was Saylor's playbook a visionary breakthrough, or just another market myth destined to unravel? When Michael Saylor first began loading his company's balance sheet with Bitcoin, he was seen as a pioneer, a corporate leader finally embracing the digital age. What followed was something even more remarkable. Wall Street began treating his stock as a proxy for Bitcoin itself, often paying a premium far above the raw value of the tokens held on the company's books. Investors were essentially buying Saylor's vision, his confidence, and his defiance of the status quo. That premium became a badge of honor, proof that markets believed he had unlocked a new model of corporate finance. Yet this premium was built on fragile ground. It depended not just on the price of Bitcoin but also on the assumption that Saylor could continue to command investor trust indefinitely. Like all premiums, it was as much about belief as it was about balance sheets. The company's rebrand to Strategy Inc. was more than a cosmetic tweak. It was a declaration that the software legacy was in the rearview mirror and that Bitcoin was the company's future. Names matter in markets. They signal direction, intent, and identity. In Saylor's mind, the rebrand was likely a way of burning bridges to the past, leaving no doubt about the company's purpose. But to many investors, it also raised the question of whether this was strength or desperation. Was the company truly transforming into a long-term Bitcoin institution, or was it doubling down on an identity it could no longer afford to abandon? In finance, rebrands carry weight because they signal conviction, but they also invite skepticism. The message is clear. The firm that was once about software intelligence now lives and dies on the volatility of crypto markets. At the core of Saylor's legacy is the corporate treasury revolution he pioneered. You see, while most companies keep excess cash in short-term bonds or stable assets, Saylor made the case that fiat was decaying under inflation and Bitcoin was the logical store of value for the 21st century. He framed it as survival, not speculation. And, well, for a time, it looked like brilliance. As Bitcoin surged, his company's holdings ballooned, and the market rewarded him with the aura of a prophet who had seen the future before anyone else. But what worked in a bull market quickly showed its fragility in downturns. By anchoring his company to Bitcoin's wild swings, Saylor ensured that fortunes would rise and fall with every tick of the crypto market. What began as a bold innovation became, over time, a gamble with no exit strategy. To keep fueling his Bitcoin acquisitions, Saylor had to raise capital, and lots of it. He began with convertible debt offerings, which the market devoured in the early days. Later he leaned on equity sales, taking advantage of the soaring stock price to print new shares. Most recently, he rolled out a preferred stock structure, promising it would be the company's main vehicle for future Bitcoin purchases. Yet, unlike earlier efforts, this one fizzled. The latest sale raised only $47 million, a fraction of the billion Saylor once conjured seemingly overnight. Investors who once lined up to fund the dream were now keeping their wallets shut. Financing shifts like these aren't just about numbers, they are signals of market confidence. When new structures fail to attract capital, it is a clear warning that belief in the strategy is fading fast. The failure to raise more than $47 million was more than a financial stumble, it was a psychological blow to the myth of Saylor's invincibility. Markets thrive on symbolism, and this shortfall was a symbol of doubt. If investors truly believed the Bitcoin thesis remained as strong as ever, they would have poured in billions. Instead, they hesitated. That hesitation has ripple effects, shaking confidence in the broader model and inviting critics to resurface. Suddenly, Strategy Inc. no longer looked like the unstoppable Bitcoin juggernaut. It looked vulnerable. And in markets, vulnerability is contagious. Once the idea of weakness sets in, investors start to see cracks everywhere, even where none existed before. One of the promises that had earned Saylor trust in earlier years was his pledge to protect shareholders from endless dilution. Issuing too many shares can crush investor confidence, and Saylor seemed to understand that. But after the preferred stock disappointment, the company returned to issuing common shares anyway, breaking that earlier vow. To many investors, this felt like betrayal. Trust is fragile in markets. Once broken, it rarely returns. The backlash was swift, and faith in Saylor's consistency began to erode. A leader who once seemed like a steady hand on the wheel was suddenly viewed as someone willing to bend promises when pressure mounted. That shift in perception was devastating because trust, more than capital, was the real currency keeping the strategy afloat. The 15% plunge in Strategy Inc.'s stock this month was not just about numbers, it was about sentiment turning. For years, Saylor's charisma and conviction kept doubters at bay. He made Bitcoin sound inevitable, and many wanted to believe him. But markets are not built on loyalty. They are built on confidence. When confidence erodes, the crowd turns quickly. The same investors who once praised Saylor as a visionary now whisper about hubris and risk. A revolt is rarely orderly. It happens in waves, with selling pressure feeding on itself. In a matter of weeks, the perception of strength can flip to fragility. This is the brutal reality of financial markets. Yesterday's hero can become today's cautionary tale with dizzying speed. Saylor's experiment was always simple in theory. Convert corporate cash into Bitcoin and let appreciation do the rest. But in practice, it created a balance sheet completely tethered to one of the most volatile assets in the world. For a while, this seemed brilliant. Every Bitcoin rally made his company's holdings look larger than life. Yet the flip side is merciless. Every Bitcoin drawdown punishes not just the company's bottom line but also its credibility. What began as a bold treasury strategy has increasingly looked like a high-stakes gamble. The lesson is clear. No matter how strong your conviction, building your financial foundation on a single, volatile asset exposes you to risks that diversification was designed to prevent. The genius of Saylor's approach always depended on timing. He launched his treasury revolution in an era of near-zero interest rates and, abundant liquidity. Investors were hungry for bold ideas and money just flowed freely. But then, when inflation surged and rates climbed, the tide really shifted. Suddenly, the leverage that once looked harmless became dangerous. What had been cheap debt was now, honestly, an expensive burden. Timing isn't everything in investing, but it can turn the difference between brilliance and disaster. For Saylor, the timing trap is brutal because his strategy leaves little room for adjustment. He is all in, and all in leaves no margin for error. For years, Strategy Inc. was treated as a bellwether for Bitcoin itself. Traders watched its stock to gauge crypto sentiment, and the company's actions rippled through the ecosystem. But now, a new narrative is forming. Perhaps this isn't a bellwether at all, but a warning sign. Maybe what Saylor built was not the future of corporate finance, but a case study in how far belief can carry a stock before reality catches up. If that's true, then the fall of the Bitcoin premium is not just about one company, it is about the limits of charisma in markets that eventually demand results. It is impossible to separate Saylor the man from Strategy Inc., the company. His defiance, his speeches, and his relentless promotion of Bitcoin became, honestly, inseparable from the brand itself. This fusion of personality and corporate strategy created an aura that lifted the company higher than numbers alone could justify. But personality is a double-edged sword. When confidence is high, charisma inspires loyalty. When doubt creeps in, charisma begins to look like ego. Saylor's greatest strength may also be his greatest weakness because markets eventually demand evidence, not speeches. And when promises clash with outcomes, charisma alone just cannot hold the line. Now, Saylor faces the hardest challenge of all: rebuilding trust in an environment where distrust is spreading fast. Investors remember broken promises, failed fundraising, and dilution. They remember that the premium they once paid is gone. Rebuilding credibility in markets is like trying to rebuild a ship in the middle of a storm. It takes time, discipline, and proof. But the question looming over Strategy Inc. is whether there is still enough patience left in the market to wait. Trust is slow to earn and quick to lose, and once the cracks are visible, the task of repair becomes almost Herculean. What can individuals learn from this saga? At its core, Saylor's story is a reminder that markets reward boldness but punish overreach. The Bitcoin premium shows how narratives can inflate value, but also how fragile those narratives become when fundamentals are tested. The financing struggles highlight the dangers of chasing growth at any cost. The broken promises underline the importance of credibility. For individual investors, the lesson is to balance conviction with caution, to pursue bold ideas without becoming blinded by them, and to ensure that the foundation of any financial plan rests on more than charisma and hype. Despite the backlash, Saylor is not alone. Other companies like Tesla and Block also hold Bitcoin, and the experiment of corporate crypto integration is far from over. The question now is whether future companies will learn from his mistakes or repeat them. The future of corporate Bitcoin plays may involve more balanced models, where Bitcoin is part of a diversified treasury strategy rather than the entire strategy itself. What Saylor started may evolve, but the risks he exposed will remain a cautionary reminder for all who follow. Michael Saylor's storm is more than a story about one company. It is about belief, risk, and the thin line between vision and hubris. His rise shows the power of conviction in shaping markets, while his stumble shows the merciless reality that conviction alone cannot hold back. Markets ultimately demand balance, discipline, and credibility. For investors, the lesson is clear. Conviction is a powerful ally, but only when grounded in fundamentals that can weather the storm. Belief can build empires, but only strategy can keep them standing when the winds turn violent.